It's Tuesday night, December 23rd, 2025. Markets are closed for the holidays soon. Silver closed the week at just over $69 an ounce, another all-time high shattered in thin trading. You've seen the charts, parabolic moves, record after record falling. Physical dealers, rationing bars, forums buzzing with countdowns, but in less than 24 hours trading resumes on Wednesday, Christmas Day, thin liquidity, holiday staffing at banks and exchanges, and a potential gamma trigger waiting. Or nothing at all. That's the tension hanging over the market tonight. Let me pull you back to where this started. Silver began 2025 around $30. Gold dominated headlines. Central banks stacking. Inflation hedges. The usual narrative. Silver played second fiddle. Industrial metal mostly. Used in solar panels, EVs, electronics. Solid demand story, but no fireworks. Then demand didn't just grow, it accelerated. Solar deployments hit records. Electric vehicle production ramped. AI data centers exploded, needing silver's unmatched conductivity for cooling and circuits. Global industrial offtake topped 665 million ounces this year, near all-time highs despite some thrifting at higher prices. Mine supply? Barely budged. Around 835 million ounces produced. Scrap recycling helped, but not enough. For the fifth straight year, the world consumed more silver than it dug up or recycled. Deficits compounding. Inventories in major vaults, London, New York, Shanghai, drew down sharply. COMEX registered stocks, the metal actually available for delivery, scraped multi-decade lows after massive December claims drained over 60% in days. London vaults emptied earlier in the year, forcing emergency air shipments and premiums spiking to $3 or more. That's when the physical tightness turned painful for paper shorts. Futures shorts had been comfortable for years. Massive open interest, easy rolls, prices capped. But when physical delivery gets demanded and there's not enough metal, price does the rationing. Shorts started covering. Prices jumped $50, then $60, now $69. Silver more than doubled in 2025, outran gold by a wide margin, 139% gains versus gold's strong but lesser run. Geopolitical chaos added fuel, rate cut bets, safe haven flows. But the accelerant everyone whispers about now? Options, especially on SLV, the biggest silver ETF. Retail and funds piled into calls, bets on higher prices. Dealers sell those calls. To hedge, they buy underlying silver exposure. Small price move? Small hedge. But Gamma flips the script. Gamma, the quiet force multiplier. It's the change in delta, the hedge ratio, for every dollar the price moves. When options cluster near the current price and expiration approaches, Gamma builds fast. Dealers go from buying a little to buying a lot as price rises. That buying pushes price higher. Higher price spikes Gamma more. More buying. Feedback loop. We saw it destroy stocks in 2021. GameStop. Names you'll remember. Silver's market is smaller, thinner liquidity. Options volume on SLV and futures exploded this year. Call buying heavy just above spot. Dealers ended last week short Gamma, meaning they amplify moves up or down. Now why Wednesday? Holiday calendar. Tuesday is Christmas Eve. Half day in some markets. Low volume. Wednesday. Christmas Day. US markets closed? No. COMEX and NYSE actually open normal hours on Christmas Day if it falls midweek, but staffing is skeletal. Bonds closed, but equities and commodities trade. Still, volumes plummet, desks half-manned, liquidity evaporates. Options expiration cycles just rolled. Heavy open interest cleared. Friday, post-expiration Gamma resets. If the rally was partly dealer hedging forcing buys, the unwind could pressure lower. Or, if fresh calls load up over the quiet days and price holds, new Gamma builds. One more explosive leg. Traders talk about call walls near 70, 75. Online chatter, Christmas Gamma trigger, countdown timers. Some irony here. The green energy boom, solar, EVs, the push to save the planet, devouring silver faster than mines can supply. Refiners can't keep up. Premiums on physical coins and bars hitting records. All while banks that historically leaned on paper shorts now face margin hikes and forced covers. Quiet humour in the timing. Christmas, season of giving, and the market might give shorts one final painful gift, or not. Hype screams $100 soon, triple digits inevitable. Reality reminds, squeezes exhaust, either shorts throw in the towel completely, or metal flows in from hidden stockpiles, India, China, private hoards at nosebleed prices, or exchanges intervene, higher margins, position limits. We've seen endings before, Hunts Brothers, $50 peak, then crash, $49 high, 70% wipeout followed. This run feels structural. Deficits deeper, industrial pull inexorable, but parabolic phases end abruptly. Let's break down the math. The uncomfortable numbers hiding in plain sight. Annual mine production, roughly 835 million ounces. Industrial demand, 665 million and climbing, even with high price substitution. Investment bars and coins, hundreds of millions more this year. ETFs like SLV, massive inflows, forcing physical buys. Total visible demand pushing 150-200 million ounce deficit, covered only by drawing inventories. COMEX total stocks dipped alarmingly. Registered, the deliverable portion, drained hard in December deliveries. London earlier this year. Vaults so thin traders paid extreme lease rates to borrow metal. The system assumes most paper contracts settle cash, or roll. Only a tiny fraction take delivery, but when even 5 to 10% stand for physical, there's not enough at current prices. Price spikes to discourage demand, or attract supply. That's the mechanism driving this rally. Not just speculation. Structural scarcity colliding with paper leverage. Short positions in futures still elevated going into the holidays. Basis trades, long physical, short paper, unwound painfully. Brokers hiking margins overnight on volatile days. Some irony again. Silver, the poor man's gold, now trading like the hottest tech stock. Volatility rivaling meme names. While gold climbs steadily, silver gaps and smashes records. The options layer adds rocket fuel. Dealers' gamma exposure flips from neutral to heavily short on fast moves. Forced buying accelerates upside. On downside, forced selling accelerates drops. Holiday trading magnifies. One big order in thin market moves price dollars, triggers stops, cascades hedging flows. Wednesday could see fireworks or eerie quiet. Contrast the narratives battling online. One camp, this is the ultimate squeeze. Physical plus gamma. Unstoppable until $100 or fair value. Whatever that is in a deficit market. Other camp, exhaustion imminent. Parabolic blow-off. Options clear. Dealers flip long gamma. Pins price. Pullback to 50s. Incoming before any new leg. Both have history. Markets don't ring bells at tops, but sentiment extremes. Everyone long. Forums unanimous. Usually mark danger. Still, fundamentals haven't flipped. Deficits project into 2026. Solar and EV demand higher. Mines slow to respond. Lead times years. So the tension builds. Zoom out further. Silver isn't isolated. It's a window into fractured systems. We've built global finance on leverage. Fractional claims. Paper far exceeding physical. It works smoothly most years. Until stress hits. Then cracks appear fast. This year, tariffs, geopolitics, rate shifts, all strained supply chains. Silver designated critical mineral. Strategic stockpiling whispers. China quietly accumulating. India importing records. All pulling metal east, while West debates monetary reset. Silver's dual role, monetary and industrial, makes it uniquely sensitive. Gold mostly hoarded, silver consumed, burned in factories, not coming back. Above ground, stocks finite, recycling limited. When industry needs it, no substitute at scale. Copper too bulky. Gold too expensive. Silver irreplaceable in many applications. That's why high prices haven't killed demand yet. Solar firms lock multi-year contracts. Pay whatever. EV makers same. Data centers can't wait. The absurdity, the transition to green, everything accelerating depletion of a finite resource. Quiet crisis brewing. Markets pricing it now. But Wednesday's potential gamma event, short-term catalyst in long-term story. If dealers forced to chase higher over holidays, $70 breaks cleanly. Momentum players pile in, shorts capitulate en masse. Fireworks. If volume stays ghost town and price drifts, gamma unwinds orderly. breather. Pullback attracts dip buyers, physical premiums still scream scarcity. Either path, underlying pressure remains. Risks cut both ways, regulators watching closely, exchanges hate disorderly markets, could raise margins Christmas week. Forced deleveraging, seen it before. Or let it run. Banks exposed, counterparties stressed, quiet interventions possible. The bigger implication, when an essential industrial metal trades with this volatility, what does it signal about supply security? About just-in-time chains? About trust in paper pricing? We've assumed infinite substitutability, endless leverage, but reality intrudes. Physical limits. Wednesday might deliver drama or anticlimax. But the deficits roll forward. Demand compounds. Supply lags. Step back to the human side. Traders staring at screens tonight. Some nursing massive gains. Others bleeding on shorts. Retail crowds that piled in late, chasing the move. Institutions caught flat-footed. Miners finally profitable after lean years. Refiners overwhelmed. Coin shops turning away orders. The stories behind the chart. One veteran short seller interviewed last week. I've rolled positions for decades. Never seen physical this tight. Margin calls hitting legacy banks. Positions built over years unwound in days. Ironic twist. Some of the same firms accused of suppressing prices historically now trapped long or covering at losses. The green narrative colliding with reality. Governments push electrification, subsidise solar, mandate EVs, all silver intensive, yet mining permitting slows, environmental hurdles, new projects delayed, supply response anemic. Prices must rise to incentivise. But volatility scares capital. Cycle feeds itself. Options market adds another layer. Retail options trading boomed this year. Weekly expirations, 0-day bets, gamma clusters forming fast, dealers scrambling real-time hedges. In normal volume, manageable. In holiday thinness, amplified. One hedge fund note circulating, potential for 5 Tortillan dal move in hours if gamma flips. Exaggeration? Maybe, but possible. Contrast with physical world, dealers quoting weeks for delivery on large bars, small bars sold out globally, premiums 20-30% over spot in some markets, while paper trades 69, disconnect growing. Arbitrage usually closes it, but when physical's scarce, paper follows. Or breaks. That's the hidden risk. If too many demand deliveries simultaneously, system strains. Exchanges built for cash settlement, not mass physical stands. Seen glimpses this month. Deliveries spiked, stocks plunged, price rationed higher. Wednesday could test further, or pass quietly. Markets love irony. Christmas Day trading, family gatherings interrupted by phone alerts, or peaceful because nothing happens. Both outcomes plausible. Hype versus reality always clashes eventually. So where does this leave us? Silver at 69, records crumbling, physical tight, options loaded, holiday liquidity trap looming. Wednesday might ignite the final gamma push. Dealers chasing, shorts folding, $75, $80 in sight fast. Or it might fizzle. Thin bids, unwinds, sharp correction as overbought extremes reset. Either way, the structural story endures. Annual deficits, industrial juggernaut, inventory depletion, 2026 projections. More of the same, worse perhaps. Demand higher, supply flat. Prices needed to balance, much higher some say. Others warn of crash post-squeeze. History mixed. But this feels different. Broader participation, strategic importance recognised, no quick fix on supply. The real unresolved question isn't Wednesday's open, or even if silver hits $100 next year. It's deeper. What happens when the world awakens fully to silver's scarcity? When industry competes directly with investors for shrinking stocks? When paper claims confront physical limits? At what price does demand finally bend? Or supply finally surge? Mines take decades. Recycling caps out, substitutes fail. We've built modern tech on cheap, abundant silver, assumed it forever, but forever ends. Some night soon, traders will face that math head on. Margins called, deliveries demanded. Vaults echoing empty. Christmas might bring a momentary spark, or lull, but the tension underneath? Unresolved, growing. And that's the thought lingering as screens go dark tonight. Not if the gamma triggers Wednesday, but but whether the system can keep pretending there's enough metal when clearly there isn't, not at any price we're ready for, yet.